All right. Again, good afternoon, everyone. Gonçalo Moreira with you this afternoon. Thanks for coming. Just a reminder, this webinar is sponsored by Vantage Point Intermarket Analysis software based on two patent pending technologies. Vantage Point forecasts market trends and trend changes with up to 86% accuracy. If you trade futures, forex, stocks, or ETFs, Vantage Point will help you become a more profitable trader. We are going to cover today contrarian thinking, contrarian trading, and we have a little controversial title for the session. Then, if everybody wants to be a contrarian, then you can't be a contrarian anymore, right? By the way, is this term familiar to the most of you? What is contrarian? What is contrarian thinking or trading? I guess from the root itself of the word, it can be understood what it is. But this will be the topic for today: contrarian trading, or contrarian investing, or contrarian thinking in a more broad sense. What we're going to cover is we will see what it means to be a contrarian. What does it mean to be a contrarian? Why should everyone want to be a contrarian? And why not everybody can be a contrarian, or not the majority of market participants? And how we can be true contrarians. Okay. So let's start with by the definition. To what contrarian means at all. Okay. The dictionary says the contrarian is a person who takes a contrary position or attitude, and more specifically, an investor who buys shares of stock when most others are selling and sells when others are buying. So this is obviously a simplistic definition, as with many definitions in the financial area, which there are many of them who are simplistic when compared with reality, which is far more complex and controversial, and this is what we are going to see. Everyone obviously wants to be a contrarian, since it is popularly accepted that the crowd, that is the majority of market players, is wrong at market turning points. Okay, so to be a contrarian is somehow in vogue, and to go with the crowd is almost like admitting a sin. Okay, so the crowd is the uninformed market players, and by uninformed we mean by that the majority. It's not someone who is not informed in terms of news, for instance, but is someone who has not the right information to beat the market. Okay, and uninformed does not mean amateurs or not professional traders, but professionals can also from time to time belong to the group of uninformed market players. Okay, so it's the status quo of the market players, which categorizes an informed trader or investor and an uninformed. Okay, then we have another type of traders, which we'll not talk today about. These are the liquidity traders. These are the ones who do not care where the price is going. They just need to exchange. They just need liquidity and to exchange the issue at the very moment. Okay, this would be liquidity players. And like in so many areas, or so many times when an idea becomes popular, its concept becomes distorted, right? And the same has happened with contrarian traders. When we think, for instance, of support and resistance, okay, there is a basic idea in technical analysis which has become very distorted as well. Just to take an example from another area of technical analysis, and it is the explanation of the significance of a support and resistance level. Usually, there is a distortion of the reality which says that the more a resistance level, for instance, is tested, the more significant it becomes. Okay, and it's not the level in itself which becomes significant, but is the movement once this level is cleared. Once this level is broken, then the movement out of that breakout becomes significant. It becomes significant because the supply located at that resistance is exhausted, so the price can move. Okay, so it's not the level in itself which becomes significant, but the action after the breakout. Okay, but it's another distorted idea that we hear a lot, that the more times the supply and demand level or support and resistance level is tested, the more important it becomes. And if this would be true, then price would constantly move in a lateral channel, because the levels tested will become more and more important, and that is not the case. So with many ideas in technical analysis are have to be sometimes questioned, okay, because they become distorted when they become very popular. Okay, so let's put the issue in perspective. The crowd, that is the majority of market players, the so-called uninformed players, are actually correct most of the time. Okay? It is at turning points that they get things wrong. Okay, at turning points. Okay, think for instance of the formation of wave 2, the personality of wave 2 according to the Elliott principle, and I will quote the Elliott principle since it is suitable to express some of the aspects of contrary investing. Think, for instance, we have this chart over here with waves labeled. We have an expanding triangle here, which is not what bothers us at the moment. We will simply look here at wave 2. After we see this ABC correction on the left side, and we see the first wave and wave 2. The personality of wave 2 is typically that of a crowd who thinks that the prior advance, in that case the prior decline, will resume. Okay, so these same people that sold here in an expectation to buy much deeper that stock or that pair, they still think the market is going in the old direction with the old trend. Okay, so they were right most of the time during this trend, but at this turning point now is where the majority gets things wrong. Okay, so that simplistic explanation that the crowd is always wrong is not exactly or does not exactly fit into reality. Okay, so there are really two moments when to go contrarian. There is a moment to follow the crowd. Okay, a moment you recognize where the crowd or the majority or the uninformed players are going, and then there is a moment to go against the crowd. Okay, and the contrarian investor or trader has to spot these two moments, not to believe simply that the crowd is always wrong, but there are really two moments. So we cannot simply conclude I'm bearish because everyone else is bullish. Okay, it's not about simply going against what we see in the charts or what we believe or what we find out that the majority is doing. It's not simply done as that. It is the when to go contrarian, which is of utmost importance. Okay, because there are these two moments when one to go with the crowd and another to go against the crowd. So you see that to be a true contrarian involves study, involves creativity, involves obviously wide experience, and above all, patience. And we will see more details on this. Okay. So contrarian means a way of thinking. It's not a strategy. That is, no strategy will have a contrarian mechanism implemented. We have indicators like the COT, the VIX, the pull-call ratio. These are considered sentiment indicators. They can be used for contrarian trading. But even if we could assess if the crowd is bullish or bearish, the market could still move to an extreme before the next turning point. And that is especially true in a leverage market like the Forex. Okay, this is an important point that goes beyond our topic here, which is something really to take note, that leverage markets can go to extreme levels. Okay, by the way, orders are positioned, and also due to some phenomena which we identify through the study of behavioral finance. Okay, and we will see a few examples in a moment. But this is something that we should really consider, take into account that any movement that we see can go much further than it is expected. Okay. So jumping to the next point, why and when is the crowd wrong? How can I know that? Why is the crowd usually wrong at turning points? Okay. Considering market mechanics, traditional wisdom tells us that when everyone joins the market in one direction, it comes to a point when no one is left to push the prices in that direction. This creates a huge imbalance in the supply-demand balance seen in reversal pattern. For instance, like the one we would have here, a potential head and shoulders, or an island reversal, or morning stars, hammers in Japanese terminology. And this is something that it's true in all time frames. Okay, but there is a detail which is not often mentioned, which is the following. It is a common behavior among, let's say, amateur traders to fade the trend while a trend progresses. And this is seen in an accumulation of positions against the trend. It's not that people go against the trend by the sake of fading the trend. Okay, it's let me repeat. It's not only that there is an accumulation of positions that go against the trend, but since most humans don't like to admit they are wrong, losing positions against the trend are kept open for a long time, while winning positions are cashed out early, okay, are liquidated early, okay, and this behavior discompensates the supply-demand equation in the aggregate, and this is the cause of most extreme movements, okay, and so while a trend would progress, those participating in the right direction would cash out, would liquidate the winning positions very early, and those who would pick the counter move, so to say, they would stay in longer, much longer, in the hope of a turning point. And at a certain point, we can see here on the right side of the screen, there is an indicator for open positions. This is taken from one of the laboratories, where we see that the accumulation of positions is you see that was taken last week, and this is a chart of Eurodollar last 15 minutes, and here you see how the most of the short positions here, where my pointer is, are in blue, means these short positions are losing. Is the big chunk of positions at that moment opened in the market are short losing positions, open at short below the current market price, which is this one. Okay, so this situation, when you assess position, open position, this situation is the most common, and especially when there is a directional movement, and eventually it comes to a point where 80% or more of the current open positions are on the losing side. Okay, and what happens usually is that these positions, if the market continues against them, at some point they will have to capitulate. Okay, either by stops being hit or by margin calls, and this causes another exuberance, a last exuberance in price. Okay, so that when really the price turns at the turning point, most of these positions are already liquidated in a loss. So the majority is already out of the market when it turns. Okay, and this happens over and over again in all time frames. Okay. So at one side we have a phenomenon studied by behavioral finance, the attachment to certain opinion. For instance, I think the market is going to rise, then I buy. And when a certain position becomes very popular, it starts to become a dogma. Okay, since the reality changes more rapidly than ever, many positions become mispriced in the marketplace. Okay, so the price does not anymore reflect the position, the thinking or the expectations of those holding those positions. And on the other hand, an equal valid concept referring to not accepting losses is another phenomenon studied by behavioral finance. Okay, so holding losses and liquidating gains. If you take this into account, this behavioral, this structural behavior through all financial markets, you already have an edge. You already start to think different. If you know that the majority of participants, professionals and non-professionals, informed and non-informed, speculative participants will hold losses much longer than gains. This is simply a fact. Okay. So a good contrarian should not go against for the sake of going against the crowd, but should learn to think in reverse and find out the reasons why the crowd may be wrong. Why the crowd may be wrong? Because the crowd may be right at some times. And indeed, if most of the time the crowd, the majority, is right. So the question from a contrarian thinking would be to find reasons why the crowd may be eventually wrong. Okay, so thinking in reverse means thinking in opposite direction to the most obvious, opposite to the general public opinions or thinking. Okay, and to a certain extent, contrarian thinking thus requires us to go also against our natural instincts. This is obviously easier said than done. But when the question becomes not whether the price will go up, but when and by how much it will go up, then it is time for some reflection and objective thinking. Okay. Many cases of so-called market manias have been studied. But for those here attending who trade short and mid-term, I think that would be the majority of us, it's better to speak of emotional fluctuations. Okay. For intraday or swing traders, we deal rather with emotional fluctuations than with manias, which emotional fluctuations have the same blueprint as a mania, but they happen on a much lower time scale. The principal difference between a mania and an emotional fluctuation is simply that a mania lasts much longer and goes to a far greater extreme, while emotional fluctuations are less intense. Okay, it's what we see continuously in our intraday or intra-week charts. So common characteristics of both, and this is important to have an idea of how on the macro scale the same blueprints from a market mania are present in a day-to-day market fluctuation, as we are accustomed to see. One of these common characteristics of both would be the fact that when gathered as a group or crowd, people rarely reason but follow blindly and emotionally what is suggested or asserted to them. Okay. This is seen on a grand scale in a mania, but it's also seen in a very short term. They also both show a crowd subject to instincts that individuals acting on their own would never show. Okay, so when we see a movement and we see events printed in the shape of price action that denote that the market is emotional, then we know there is a crowd behind. Okay, then at that moment the contrarian is in us is awakened. During both manias and emotional fluctuations, traders and investors involuntarily follow the impulses of the crowd. Okay, we easily succumb to the herd instinct. This is something that we all experienced. Some of us will recall it fresh. Others maybe have already created some distance to that phenomena, but we have all experienced it, that we succumb to this herd instinct and wish to follow what we see as a crowd movement. Okay. In manias and emotional extremes, there is also a generalized belief in fast and easy gains. This is seen on an intraday scale as much in a longer bull market or bubble or mania. Okay, there's this belief that I can make fast gains in easily in short time. Okay. Mm-hmm. It's also common for funds, money to be available. Okay. So there are indicators where we can see if cash is available for investment. Speaking of a general market view, but also in terms of a smaller intraday scale, we can think of leverage. If leverage is still available, if we haven't seen yet a cascading effect of stop losses being hit or or margin calls, then we know that leverage is still possibly available. So we have to think also in terms. We start here to think in terms of the counterparty, the other traders, where they most likely have their stops located, and how far these stops are. And we can look to the pip value of certain pairs. Is the pip value higher? If the pip value is higher, means the stops are probably closer because of the high cost of trading that pair. Okay, and all this thinking or reasoning can lead us to gather an idea of the leverage being used. Okay. There is also a fear of missing out a trade or an investment opportunity. This is common to both. Okay, a huge spike seen on a chart is sometimes enough to awaken our desire to be on board of that price movement. Okay, we see a large upward candle and we jump in, and finally that candle closes near the open price and leaves a huge upper shadow, and we enter it at the upper part. Okay, and we are in a loss. So that movement, we succumb to that instinct to follow the crowd, and we had this fear of missing out a trade. And this is something that again and again, from experience, I can tell you that leads you to losses. And most of the time, and this is something you probably have heard a lot of times, most of the time the market rewards us with a second opportunity, if not a third. But still, we prefer many times to go with the first opportunity, and many times we enter at price levels which are not advantageous. Okay, I think this is something that is probably very obvious to all of you. Also, the risk appetite rises in an emotional market or in a mania. Think of the carry trade, for instance. How the markets were at that time when the carry trade was hot. So there is really this risk appetite. Okay, and the fact that exuberant moves last longer than the expectations of virtually everyone. Okay, so when everyone is astonished by how long a movement goes. Okay, and this leads more people to jump on board. So the market, like a good contrarian, anticipates what will happen in the future. And this so-called discounting mechanism means that the crowd will already have sold an instrument in anticipation of the worst. So the selling will be over long before the turnaround is apparent. Okay, in a decline, for instance, sellers become less and less until there is one last seller at the very bottom of a lower shadow who sells at the worst possible price. Okay, so who hasn't been in that place at least one time. Okay, so let us see how to anticipate this situation. And we come to the third part of the session. How is contrarian trading applied? How can we train ourselves to become a contrarian? If we wish to think differently from the crowd, we need to develop a mechanism or a series of mechanisms to stop us from slipping into bad habits. Okay, we have mentioned some of them. This impulsive trading, the fear of missing out a trade, an opportunity, and so on and so on. So, in fact, our main character weakness is fear in all its manifestations. but fear is usually the basis for a lot of bad habits that we can adopt. Okay, so when we think of fear, obviously something abstract, and we may in our minds make some image of what fear is, but imagine fear like a tree with many leaves, and each leaf is one manifestation of fear. So there are really lots of manifestations of fear. Okay, fear followed by pride of opinion and followed by greed. Okay, if we maybe it would be pride of opinion and greed part of a fear manifestation. This is something to think about. So bad habits associated with these weaknesses prevent the average person from maintaining an objective stance. And it also maintains us far from sustaining a contemplative attitude towards reality. And by contemplative, I do not mean something passive, but a distanced objective observation of reality, with us being part of that reality. Okay, by this is the word contemplative to be understood. So going opposite to the crowd is, as we see, is not as easy as it sounds, because we cannot go against something we are not aware of. To start with, if we haven't successfully dealt with our own bias, opinions, beliefs, how can we feel any empathy towards what the others are thinking or feeling? And this means that empathy starts with oneself. Okay, what thoughts do I have when I see a certain market move, a certain exuberation in price? What thoughts do I entertain? Do I want to be part of that movement? Do I feel the need to participate in that movement? Can I find somewhere in my mind, in my being, can I find a little piece of strength, of patience, and hold that impulse and watch what the market finally does? Okay, it's also about finding somewhere in us the strength to be aware at all times, and especially at turning points. And turning points, emotional points, are the ones where we easily forget to take a distance. Because if I'm talking here, you are listening, it's easy to think, okay, well, I can be aware of that. I can make all those questions to myself when in front of a chart. But at the critical moments, this is where we disconnect from our contemplative reality, or from contemplative attitude. We disconnect and we become part of the crowd. Okay, this is why it is so difficult to think like a contrarian, or to act like a contrarian. Okay, because this is at decisive moments when this thinking is needed. Okay? It's not when the majority is right. At that point, it's easy to join the majority, to go with the crowd, to make money with the crowd. But the big money is made at turning points, at those points where risk is less and where opportunity or reward is the biggest. And at those turning points where market is emotional, rest assured that most of us have these big difficulties of really becoming aware. Okay, so let's recall. To say I'm bearish because everyone is bullish is not enough. Okay, we have to remember that the crowd is right most of the time. It's only at turning points that it is not. That is, at those levels where you can take the most of the market, where you can make more money with less risk. So we need to justify our view with a sound argument, be it technically, fundamentally derived, or any other combination or orientation. Okay. So requirements for contrarian thinking. For instance, we can make a list of those arguments in favor and against the current market trend and evaluate as objectively as we can which side is better reasoned. Going through this exercise will help you recognize which one is more likely to be valid. When some vital clues that are initially invisible to the unthinking majority start to materialize, then we have already an edge. Okay? It is at this very moment that we need the crowd to recognize the new trend and have them pushing our position in our favor. Okay? But very few of us really take the trouble of looking at both aspects of an argument ever, and not only in trading, in our day-to-day. We either derive our opinions secondhand from what we hear or read, or we just conveniently take the signals generated by a technical indicator or trading system. Okay? And this is also a bad habit, just to follow an indicator or to follow a system. Many times at the beginning of our trading career, we think, well, I just need a system to follow, right? And I have the discipline. Every time the system says buy, I buy. And every time the system says sell, I sell. And this way, technical analysis will never work. Okay, this way. And this is the big dilemma, where while many people say technical analysis doesn't work, it doesn't work if used this way. If it is used just blindly, following the signals. Indicators are obviously made to generate signals, but you and your brain are made to interpret reality in a much complexer way than an indicator does. An indicator is finally a reduction of information, of all information available in reality. The chart is already an abbreviation of that, and the indicator transforms that price series into a different way of explaining that price series. But it's a reduction of reality, a drastic reduction of what is happening behind the scenes. So if we follow blindly an indicator or a strategy without thinking, then we are belonging to the crowd. It's not necessarily that we have to follow a guru or some news feed or whatever. Simply following blindly mechanistically an indicator. So it's about thinking, if I sell, who is going to buy from me, right? So I'm going to develop empathy towards the counterparty and think like I would be the counterparty. So I'll think about my position being the counterparty. Where would I place my stops? Where will I place my targets? So I have to, if I buy, I think who's going to sell to me? And if I sell, who is going to buy from me? Okay, and this way you train to see the market from a contrarian perspective, because it's the counterparty who is going to take your trade. Eventually, it's the market maker, but the market maker is not going to lose every time. And the market maker business is the spread. So by thinking where the counterparty may have his or her stops located, already puts you in a completely different position, right? And another mechanic trained by or mechanism trained by contrarians is not to extrapolate the future from present or past conditions. Okay, it's true that history and patterns from a technical perspective repeat themselves, but they do not repeat in a mechanistic way. Okay, here is where cycle theories are so useful, or Elliott wave. I always recommend to the study of Elliott wave, not because of it's a complex theory. It really requires deep study to understand it, but it's the fact that by studying cycle theories or theory like Elliott wave, then your mind becomes accustomed to think in terms of cycles, to see a progress within a progress, to see this contrary moves in a progress. So every time the market wants to achieve a progress, it needs to retrace from time to time, and everything that goes up goes down, and this is, besides being a cyclic continuum, is also fractal in nature, in the sense that if you zoom in into a wave, you see smaller waves with exactly the same form and appearance. They are different in time length, they are different in magnitude, in price magnitude, but the relationships of proportions and their shapes, being triangular for corrections, being straight advanced lines in actionary waves, they all have these same characteristics across all time frames, and that is the usefulness of studying cycles or Elliott waves, because it trains your mind to expect a return, a correction, and it creates this patience to get in the market at better price levels. And if an opportunity is lost, it is lost tomorrow or in a couple hours. There'll be surely another opportunity, or in 5 minutes in another instrument. So contrarian approach does not lend itself to a mechanistic nor simplistic approach. This is why there is no contrarian strategy in itself. Not even mean reversions, divergences, etc. are considered contrarian. Okay? But instead, we can impregnate a strategy or a trading method with a contrarian attitude. If I buy on dips or sell in rallies, so I'm impregnating a strategy with a contrarian attitude. Okay? We will not go into how to buy on dips or how to sell in rallies here. It's out of the context, or at least of the scope, and you have lots of other webinars about that point. But it's not that the method in itself is contrarian. If you say I trade divergences or mean reversions, so do not take them as a contrarian signal, because they are not. So just by taking every divergence, you will not win. Okay? Because again, we have to apply our thinking and our deeper analysis to the use of all the tools that we have available. Okay. So remember that events, not people, determine the future. And by events, not only events like the news release or an economical data release, but events can be events in price action itself. Price hitting a certain area, hitting a confluence of technical indicators, stepping out of the third standard deviation. All this is meant by events. Okay. Plus everything that happens, everything that is exogenous to to price in the first instance, and certain news or anything that might affect a price. But it's events, not the people, that determine the future and the future of price. So it's important for contrarians to analyze events just as much as viewpoints and sentiment across the marketplace, because events shape attitudes and condition, therefore, the expectations of market participants. And these, in turn, give place to other actions and events which impact again on expectations and so on. It's more like a dance and not so much like a linear sequence of causes and effects. Okay, it's more like a dance, like a cycle, and not a deterministic sequence of cause and effect. Okay, this is something that especially in the West, we have in Western cultures, we have inclination to think in terms of in deterministic terms. That if something happens, then if A happens, B is the cause or the effect. Okay, and this effect is again the cause of another effect, and so on. And we do not or we have difficulty in thinking that one effect might have two causes, or three causes, or four causes, or four causes may have two effects, or one cause may have three effects. Okay, and to link them in a much complex structure. This is something that it's probably from a cultural point of view easier for someone who grew up in Eastern cultures than Western cultures. So for those of you, we are in the Western side, so this is something that we have to develop, the cyclical understanding of reality, and also this the contemplative attitude towards the activity. Okay, so a manifestation of the general opinion, for instance, is the cover page of financial periodical. Is a well-known theory of a way to apply contrarian investing, which I found interesting to show it to you here. We see here two cover pages from The Economist, very, very recent front covers. And the contrarian forex trader in this case should take advantage of this knowledge and start thinking in the opposite direction when something related to currencies appears in the front page of The Economist, for instance. Okay, by skimming through a number of this financial specialized economical or financial press is a good way to start applying contrarian thinking. Okay, here we have, for instance, an example from February 7th February 2004. This was the front page, and we see the let the dollar drop was the motto, and this was printed, this edition, after this huge rally in the euro dollar. Okay, so let the dollar drop means let the pair go another 1,000 pips up or whatever, and it was printed on Saturday here, and you see a week later the market declined almost the half of what it was going up. So as for these two last editions, it is still to see the effect in the market, but I would stay tuned to that as a contrarian. Okay, to wrap up quickly, some conclusions. The contrarian's task is thus to find a way to quantify in which direction most market participants are going, and ask if there is enough energy to sustain that movement. Okay, and also to obviously to apply creativity. Okay, if we try to answer the questions, what if we all become contrarian contrarians or contrarian traders? The answer is simple. It is unlikely that the true contrarian trading is implemented by the majority. Okay? Simply because when we are faced with a choice to apply creativity or to follow what others do, we prefer to imitate most of the time. We prefer to imitate rather than to create. Okay. So any task that requires work and study to lead to a positive result will never be a widespread practice. And this could be backtesting, this could be studying topics related to risk control, position sizing, or have a closer look to Elliott waves, to cycle theories, studying intermarket relationships, whatever. Studying whatever, but deeply. There is the minority does it. So if you're serious about trading, you can have already an edge over the majority by taking things seriously. Okay, this is how you start to become a contrarian. Okay, it's not just by thinking opposite. It's not that simple. Okay, obvious thinking when applied to financial markets often lead to erroneous conclusions. Okay, and nobody is born a contrarian. It's something that needs to be developed by avoiding to conform to our current ways of thinking, by training our minds to go in directions contrary to the obvious, and to discover the intentions and expectations of the counterparty. Okay. All right. So this was it. I think we are close to the end. There are still a couple minutes. If there is any question, I will try to answer it, obviously. Okay, seems like there is no question. Or if there is, it's not always easy to formulate questions, I know that, but I think that formulating questions is one way to learn, because by formulating, putting in words a certain idea or a certain depth that might be abstract is a way to start learning about something, the way we ask things. And sometimes we don't be afraid to ask obvious things, because by asking the obvious, I will not answer the obvious. I will try to answer with something that I think is of value to you. Okay, so be it with me or with any of the participants, with the next participant coming, don't be afraid to ask obvious things. Okay, because most of us have accumulated a certain experience in the industry, and we might see the obvious as something very important, and we might have something to add to answer to you, which can be of value. So Boyke asks if I mean counter trend trading by contrarian. I think this is something that was explained. Means it's not exactly against the trend, but against the opinion or the sentiment of the majority of market participants. Okay, it's not about technically fading the trend or going against the trend, but to know exactly when is the moment to go with the trend and when is the moment to go against the trend or to profit from the next move of correction against the trend. Okay, so it's by distinguishing these two moments, because the majority of the time, most of the time, the majority is right about market direction. The majority is right. I mean, the majority, if we see a chart going up for days or weeks, everyone knows that the chart is going up. Okay, so this is something that and everyone wants to be part of it, will try to be part of it, and everyone recognizes that as a trend. So it's not by following the trend or adhering to a market move that the majority is wrong. It's at the turning points. Those points where entering the market is most profitable because you risk less for the amount that you can get. Okay, because it's in professional trading, especially in institutional trading, the question is always risk and reward. And by reward, another concept would be the probability. Okay, so what is the probability of making a gain, and what is the risk? And this is always the question. Okay. Okay. So institutional traders will always try to get in at the best possible price, with the less risk and the better probability of that price going in their favor. Okay, and for a price to go in your favor, you have to have the majority with you, because the majority pushes prices. Okay, so it's not that we just want to fade all the time the market and the majority. You can't. Okay, so it's a bit more complex than that. Adam says be contrarian is a really great thing for who try to follow the trend. Right? Yeah, you can be a contrarian by following the trend to a certain extent, obviously, because you know when to go with the trend. Exactly. All right. I think the next speaker should be around. Thank you very much for your time, for attending. Hope to see you soon in our next session. And nice trading, happy trading, and good afternoon. Bye.